Let's talk about why you never lose in a ranging market. Why I never lose in a ranging market. In all the trading years, in the 30 years that I've been trading, ranging markets have been my most profitable trades. And there's a good reason for that, and it's in the name. It's ranging. It's going in one direction. And if you trade with the trend, then guess what? Really, guess what? Trading with the trend is your friend. It's a saying we got in the markets, the trend is your friend. So when you're trading with the trend, when you're trading with the range, you're gonna never lose in the markets. But how do you do that? How do you effect that profitably? And how do you figure out where the ranges are? Well, I'm going to take you to the charts today, and I'm going to show you how you can easily identify trends, how you can easily take your trades from the top down, and how you can trade with price action, because it's all about price action at the end of the day, guys. It's all about looking at the chart and thinking, wow, that's the trade I want to take. But it's not about the squiggly lines. It's not about the charts. It's about your psychology, and it's about how you approach the markets and how your business plan works. And after the charts, I'm going to talk to you about that as well. We're going to talk about how you can approach the market in such a way that you can be a profitable trader instead of a losing trader. Losing's not good, guys. Losing's rather bad. So we want to be a winning trader. We don't want to be a losing trader. But it's all about the trends. It's all about ranging, and it's all about following the trend at the end of the day. We trade the market three ways. Number one, I trade with a trend. Number two, I trade in a range. And number three, I counter trade the trend. Which one of those three do you think is the most dangerous? You can tell me at the end of the video. Perhaps put it in the comments and we'll have a look. But first, guys, don't forget, trading is risky. 80% of traders lose money. Well, 70 to 80% of traders lose money. Swing trading, position trading, trading on the daily, trading on the 4 hour, trading on the 1 hour. But guess what? 99% of traders lose money trading on the short term, the 5 minutes, the 1 minutes. One person even mentioned trading on a tick chart. Can any of you imagine what it's like trading on a tick chart? You might as well go to a casino, man. There's no point in trying to trade on a tick chart. That's a gamble and a half, dudes. No. Trading on the 5 minute, 99% of traders are probably going to lose money. So if you don't like risk and you don't like losing money, then guess what my saying is? Don't trade. Easy, don't trade. If you want a free Forex book, drop down to the description. I've got one there for you. Totally free. It's a PDF. Just download it. Enjoy it, guys. I'm not asking you anything for it. And in that description, there's all kinds of nice things like a funded trader account and a blog with trade of the day and all these fancy things that you might want. Anyway, to get on with it, let's go to the charts and let's go and have a look at how you can identify trends in the market and how you can be profitable in a ranging market. How do you pick out a ranging market? How do you know when something's ranging? Or, well, I always suggest firstly that we go to the day or the weekly and we get a picture from that. This is a day chart. This is the S&P 500, and this is clearly a bullish market. It's in structure. What does structure look like? I mean, structure is basically that. Okay. It doesn't go up in straight lines, but it does that. What do you think, guys? Hey? That's structure. It goes up in a row like that. So it starts there, up, down, up, down, up, down, up, but it's going up in a general uptrend, and it'll do the same to the downside. Nothing tricky about it, nothing unusual. If you struggle to see it in candle form, then simply turn it into a line chart, and the line chart gives you the closing prices, and that's where the support and resistance comes in and gives you much more information based on the closing prices. But on a day chart, you can clearly see that this S&P 500 is ranging to the upside. It's a bullish market and it's in structure. So this becomes a really good bullish trade. You can effectively trade this long every time it relaxes down a bit. You can take a long trade. This one, I would wait a little bit more, maybe for it to get a little bit further down before I take a long trade. But it hasn't gone short yet. It hasn't broken structure. There's no short trade here. This is contrary to the FTSE, which is a ranging trade. Look, it was in a bullish mode. It was ranging, but then it became a ranging straight market. It's sort of no longer bullish, it's ranging up and down. And you can't fail to make money in this kind of ranging market either, okay? You've got a trending market and then you've got it ranging to the side. Now, making money in a trending market, in a trending range, okay, is really easy because you can see the markets going straight up and you're picking off, as you go up, you're picking off the trades with a simple trend line going up to the side. Every time it hits this trend support, you can effectively take a trade. But in a ranging market like this one, it's so much easier, guys, because all you do is every time it hits the resistance, you take a short. Every time it hits the support, you take a long trade. How do we get the trade? How do we get the support and resistance? How do we add the support and resistance into a ranging market? Well, very easy. What we do is we take it to the line chart. We look for the closing prices, and every time it hits the top with a closing price, that's the top. That's like a magnet. We draw this block in from the highest to the lowest one. That just gives us an area where there's going to be a bunch of orders. Same at the bottom, where it hits the bottom every time, at least 3 times. Draw it in. That's an area where there's going to be a bunch of orders. And then what we do is we normally take it back to the candle chart and we go back to the 4-hour chart, because we like to trade on the 4 hours. Gives us a few more trades. But then what I'm looking for is, for a short trade, big red candle out of the resistance, and for a long trade, a big green candle out of the support. And that's as simple as it gets. That's you trading in a range. Trade off the high, trade off the low, and it works every time. So this is going to be a long trade over here. When we get a green candle on the 4-hour that closes, there's 2 hours and 25 minutes left. Get a green candle that closes on the 4-hour. On the outside of this support, you can take a long trade to the upside. That's your ranging market. You can never lose in this ranging market. Put your stop loss below the areas, because if it breaks out of the area, then the ranging market's over. It's simple. It's not rocket science. The trending market, you never lose there either, because the market is going to the upside. Every time it hits the trend support or the trend resistance, you take the short the same way, and you take the long the same way. What we look for in the trending markets is when it comes back. Every time it comes back, we take a trade. Every time it comes back, we take the trade. The DAX at the moment is not in a ranging market. This has come up in a bullish market. It's gone into a range, but it has created a rather serious head and shoulders pattern. So we've taken a short on that, which has gone against us, which we are looking at when it breaks through, and it gives us that the head and shoulders pattern to the downside. Brent is in a ranging market to the not in a range market, it's in a trending market to the downside, but it is also in a range. It's in a huge range. The range for oil is between 86 and 70 in this area. So at the moment, you can take a long trade with a view to it going up towards the 86 again in that range, because it's trading in that range over a long period of time. You see it staying in that range. You can just trade it up and down in that range. And if you're patient enough, you'll take profits based on those ranging markets. Whereas the euro US dollar is in a trending market. The trend is going down and it's falling hard. You want to go short on a trending market. So you just keep going short, keep going short, keep going short, because it's trending. Counter trends are the most difficult, as I say. Those are the ones that are going to give you the biggest headache. And I said to you in the beginning, tell me in the comments which one you think is the most difficult. A counter trend trade will be your most difficult trade. And why is that? Because in a counter trend trade, what you've got to do is you've got to wait for it to break structure. In other words, you've got to wait for this price to go up and break through the trend resistance, or otherwise go above the last high before it breaks trend. Here on the US 500, the opposite way around in a similar fashion. I'm just going to take it to the day, because that's what we're looking at on the day, is more like the scenario. Okay, so what you're waiting for here is for the price to break past this actual trend support level. You want it to break down below here before that trend is broken. Or you at least want it to break below the last low to show you that the trend is now changing and you can trade against that trend. But as I said, never lose in a ranging market as long as something is in a range And the best example is actually Brent, because that does always stay in this range. The biggest range for Brent is between 65 and 105, but as it stands at the moment, it tends to stay in this ranging area, and you can trade it in that area as much as you want. There are many more examples like this that you can follow. They'll make you quite a large sum of money in the markets. 3 ways to trade, guys. Trade with a trend, trade in a range, and counter trade the trades. Counter trading is always going to be your most difficult trade. So that's the charts. You've seen the charts, you've had a look at the charts, and you've decided, well, now I know how to trade price action. Let me rush off and go and do my trading. Let me tell you something. We just had an election in the USA where Donald Trump was elected once again. And what I remember is when he was in charge last time round, the stock market was ranging. In fact, you could literally buy the S&P and just leave it, walk away, and come back and have a look at it later on in the day and see how much profit you've made. That's how ranging it was. It was just going up all the time. Now, I wonder if that's going to happen again. Well, most likely not. Got my doubts. But you never know. You never know. Wouldn't that be great if you had a range running in that sort of way? It would be great to have that again. But I doubt we're going to have that again. But just to point out to you, that was probably one of my most profitable periods ever, because the market never really turned against you until the elections came around and a new government came in and Joe Biden took charge, and then suddenly the markets took a turn. So it's kind of weird and it's kind of strange, and I don't know why that happened, but it did. And then suddenly you had to change your trading approach completely to suit what's happening, because you've become so used to this just buy. I mean, I'd actually adopted an almost new trading approach where I would just add to my trade every week. I would just like add some more. It was like investing. I was like, well, this thing's just going up some more. I'll just throw some more money at it. And the next week it goes up some more. I'll just buy some more contracts. Eventually, you start with one contract and you end up with 500 contracts of S&P. And you're like, what's going on here? It just gets bigger and bigger and bigger. And then suddenly when it does turn around, you've got to think quick, because suddenly you've got 500 contracts that are dropping to the ground. That's the problem with that sort of scenario. So you've got to watch yourself in a ranging market as well, because it will end at some point in its lifetime. It will come to some kind of a sticky end, let's say. So you've got to watch out for those sticky ends. But how do you approach trading in such a way that you can be profitable? Because it's not all about these lines. I mean, at the end of the day, there's human beings behind the market. There's human beings taking the trades. The lines give you high probability trade. And of course, when a market's trending, that's the most high probability trade that you're ever going to be able to take, because you can see it's going in that direction. It's not turning around. So that's a high probability trade. That's all the lines do for you. They give you that high probability. But at the end of the day, the market is a 50-50 game, because the market is made up of buyers and it's made up of sellers, lots of them, many of them. And would you believe they all want to win? Every single one of those buyers and sellers wants to win. None of them want to lose. They've all got a high probability system. They all believe that they're going to win in the market. I'm going to have a sip of coffee, because it's Coffee with Rob. So, in case you didn't notice the title of the series, it's Coffee with Rob. And, we don't have coffee together, so we're having coffee today. Makes a change, doesn't it? Besides the point, we want to talk about how we're going to manage our risk in the markets and how we're going to take those trades, because a high probability trade is what everybody believes they have. When it comes to trading real money, suddenly there's a fear receptor that kicks in that almost changes everything for you in your mind. Suddenly there's a whole bunch of adrenaline running around in your body, and suddenly there's a whole bunch of things that actually change for you. And that needs to be held back, sorted out, calmed down. Not easy, not an easy thing to do. The only way to control this is to take the size of your account and trade 1% of it on every trade. So in other words, if you have $100,000 account, keep it at a $100,000 account. So if you make $100,000 profit, take the $100,000 profit and put it in the bank, leave the account at a $100,000 account. I say this because you have to get used to trading with $200,000, and you're not used to it, even if you win. So you're used to trading with $100,000. Maybe you're comfortable with $1,000 loss. So now what you do is you say, each and every trade that I take will have a stop loss or an invalidation of $1,000. This way, you can take 10 trades and you will only lose 10% of your account if every single trade lost. And in general, for you to lose 10 trades in a row is very, very, very unusual. Not to say it can't happen, but it shouldn't. Especially if you've got a high probability system that you're working with hopefully some kind of a win rate, hopefully a 50-50 win rate. Because what you want to do is you want to win 5 trades and you want to lose 5 trades. The 5 trades that you use, you want to lose 1, and the 5 trades that you win, you want to win 2. Pretty simple, straightforward strategy. Now, I'm not saying this has to be an exact science. If you take a trade that's 1-to-1 or 1.5-to-1, so be it. You're making a profit. But you don't want your profits to be the same as your losses, because then you're going to end up with 0 at the end of the day. You want to make a profit. So now you risk the $1,000 on a trade. What you do, you go, you have a look at where the invalidation is, where your stop loss is going to be on that trade. Where's your stop loss going to be? It's going to be there. Doesn't matter where it is, just decide where that point is. Then work out how many contracts work out to $1,000 between the cost price and that stop loss. That's the amount of contracts you're going to purchase. Then you purchase that number of contracts with a view to a take profit at least at a 1.5 or a 2-to-1 over what your stop loss is, so that you're making more profit at least. Step 1 of your business plan is now complete. You have a trade with a $1,000 stop loss and a decent target. What's step 2 of your business plan? Because you don't need to write this down, guys. It's not rocket science. Let's be perfectly honest. You can remember this. Or if you can't, just come back and watch this video. Not that difficult. Just click play. Watch it over and over again if you want. I don't mind. And while you're there, subscribe. It helps. Nothing wrong with that. Geez, we've got 7,000 something subscribers already, and it's climbing, and we're heading for the 10,000. It's amazing how this channel has grown. But anyway, let's get to it. So now you've got your $1,000 stop loss. You've got your trade in. Part 1 of the business plan is now complete. Now we go for part 2. Part 2 of your business plan is really simple. And that is, if it starts going into a profit and it goes $500, $600, $700 into a profit, take your stop loss, move it up to break even. Now, why do I tell you to move your stop loss up to break even when it's in profit? Why don't I just take profit? Well, firstly, because your target is $2,000, not $700. And secondly, it just makes your trade free. In other words, if your stop loss comes back and takes it out, it just gives you a free trade. And at the end of the day, you're trying to make a profit. Now you watch it go up past the $1,000, goes up to $1,300, $1,400. Start moving your stop loss right up behind it. Move your stop loss up to $1,000 in profit. You're making $400. If it comes back and takes that out, so be it, guys. And let it go up. If it gets to the $2,000 target, just take your stop loss and put it right up behind it. Because if it comes back and takes it out, you've made your target. If it doesn't, if it keeps on going, bonus, you're making more money. Okay, and that's as simple as the business plan gets. But there is a clause in the business plan, a little clause. The fine print says if it goes into a loss, don't move the stop loss further out. If it goes into a loss, do not dollar cost average your trade. Don't try and average your trade out and try and get it back onto even. I've seen it end in tears so many times. How many times? And you know what causes this? Is the overconfidence of a trade. So many times you will see a trade, you'll take a trade, and in your mind, there is just no way. You've seen this setup how many times? There's just no way that this trade can lose. In your mind, this is just a humding. This is a winner for sure. And it starts losing on you. Do you know, you will remain convinced until you are bankrupt that that trade's going to win. Because you told yourself that from the start. That's the psychology behind it. Instead of understanding that you might be wrong. Understanding that you might have just got that wrong. I mean, you could get 5, 6, 7 trades in a row wrong as well. Just accept it. Accept that you can be wrong, that you could have made a mistake. Let it take your stop loss and move on to the next one. There'll be another trade that you'll be wholeheartedly confident that it's going to win because there's no way that it can lose. There's many trades like that, but that's what causes you to move your stop loss out. That's what causes you to dollar cost average, because your overconfidence is going to bankrupt you. let the stop losses take themselves out. Move on, guys, move on. So that's your business plan. That's as easy as it gets. That's from me to you. That's my information that I'm imparting. It's not trading advice, guys. It's just my information that I'm imparting to you that you can use any way you want. Remember, you can use any system in the market that you want. You can use any time frame that you want. You can trade futures, contracts, commodities, indexes, shares, whatever you like. The system or strategy will always, always, always remain the same. It's not going to change. The approach, the strategy will remain the same no matter what trading you're approaching. And some of you will be good at 5-minute time frames. Some of you will be good at weekly time frames. It just depends on your personality. Just depends who you are. If you are good at the 5-minute time frames, good for you, because it is a very difficult thing to do. Thank you for watching. I hope you enjoyed the video. Don't forget to come down for the weekly rundowns, and also join us for the live shows on the Tuesday and the Thursday, where we can talk and chat and answer questions where need be. I can't always answer the comments 100% because it's really difficult to answer them sometimes in writing on the comments, and there's so many comments and I have to sit and answer questions this long. So if you can possibly make the comment, I'll try and answer it. If I can't answer it, I'll try and get to you in the live shows if possible and give you the answers there. Thank you for watching, guys. Don't forget, if you want to know more about my system, watch this last video. It's going to give you a lot of detail. Thanks for watching. Cheers and bye.